Good Tuesday morning, Market Chameleons. Everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, good morning, Dimitri.
Good morning, Will. How are you?
Great.
Good morning, everyone. Let me share my screen here. While I'm doing that, I want to remind you guys that we are doing a webinar today at 2 p.m. Eastern with Interactive Brokers. And it will be on looking at a analysis of single leg option trades. We're going to go over a dashboard and see what type of insights we could get analyzing single leg option trades. You have to register with Interactive Brokers because they will be hosting it. It won't be on YouTube like this example we're doing today in the morning. And will you provide that link?
Yeah, links in that. I just put it in.
Okay. And this morning, what we'll do is continue the long call option screener, looking at the different analytics and screens. We've been covering this for a couple days now, and what we'll do is review today a particular tab on the screen, so you could see that we have this data table below with different analytics, and then you could tab through, which provides other analytics for you. We're going to look at the strategy payoff tab today, and we might do a shorter version today just because we do have that other webinar coming up later, and wanted to do some things to prepare for that. So let's just quickly review the long call option screener. If you're looking for it under screeners and you go to the right, you can see right here long calls. You click on it, you will arrive at this page, and this screener looks at just from the perspective of analyzing a call option from the long side, or if you're purchasing, if you're going to own the option, and we're looking at the call option. If we're looking at the bid and an offer, we're analyzing the ask price of the call. So this way, we're looking at it if a price that that is firm and you can buy at, and of course, as a trader, you're going to always try to get a better execution. You want to try to do better than the ask price. If you could do below the ask price or midpoint or below the midpoint, that's even better, because the less you pay for an option, then the less risk you have and the more potential reward. But as a starting point, we're going to look at the ask price of the option. It defaults to the next monthly expiration. This screener, if you click on it, you could select a different expiration or select multiple expirations within a certain expiration dates. We're here, the next 14 days, 30 days, and so forth. So in the last couple of days, what we did was cover the option. So over here, we see a bunch of different options available. For example, Apple, even if we only look at December 20th expiration, because that's what we have selected here. For expiration, we have December 20th. So all these will be December 20th call options. We have different strikes. So we could analyze different strikes within the same expiration. So here are the strikes. You have 252.5, 245, 255. And these strikes are a different distance away from the spot price. Some are above the spot price, some are below, some are close to right at the money, and some could be very far away. So we could analyze all these options and see, which ones fit your hold on.
Below.
Sorry. So, what we did before today was look at the price of the option and compare it to a theoretical value based on how the stock performed historically, and we looked at the historical win rate, probability of touch. We also looked at the historical distribution of the stock. We analyzed that yesterday, and the seasonality. So today, we're going to look at the strategy payoffs. And the idea here is, if we're looking at this option, let's just say in Apple, we see that this option is $1.09 right now. That's the ask price. And so that's what we're going to be risking, right? If we purchase it for $1.09, well, if you buy a call option, that's for $1.09, that's your risk. If it goes to zero, the stock stays below the strike price at expiration. This option will be worthless. So you lose $1.09. But the question is, what is our potential gain? If we're risking $1.09, what are we potentially, what is our potential gain on this option? Is it, if we're risking $1.09 and our potential gain is, 1 penny, might not even be worth it, or 2 pennies, or what are we looking at here? If we risk it, we try to calculate, well, what is the potential reward? Okay, the payoff, the return. And of course, it could be unlimited, theoretically the stock could go up to whatever. But obviously there's some constraint that's not realistic. What do we think, realistically, what is the potential gain here? So we have to come up with some kind of methodology or formula to try to estimate that. Okay, because if you play certain games, you go to a casino, you actually know right off the bat, this is what I risk, and this is what I could make. It's predefined for you. But here it's not like predefined. There's no rule here that says, this call will either be worth $2 at expiration or zero. There's no like set payoff rule, because we don't know where the stock is going to be. It's dependent on where the stock is at expiration. So we need a way to try to estimate that, where the stock may end up at expiration. And it could be a range of prices, right? It doesn't have to be one price. So to do that, right, we could look at how the stock moved historically and then try to estimate the payoff from that. Okay, so let's say these are strategy payoffs. And you could see that we have these ranges here. So the first payoff is, what if the stock is down 1 standard deviation from today's price at expiration? We're down 1 standard deviation, right, based on historical volatility. Well, there you lose 100% of your what you had amount at risk. In this case, $1.09, because the stock will be out of that option will be out of the money. If the stock goes down from 246.90 down from 1 standard deviation, well, obviously the 252.5 strike will be out of the money, so you lost, right, $1.09. We could also look at it from the perspective of, what does the stock move on average, okay, in this 10-day, whatever 9-day period, holding period. So you can look at historical data and say, give me the positives, give me the negative moves. On average, what does it move? Is it slightly positive? Is it slightly negative? Is it very positive? So give me the average move. And here we have two average moves. One is based on a seasonal move. That's looking at like we've reviewed yesterday, the calendar period of, from today's date, let's say December 10th to the expiration December 20th. So historically, if we looked at the average move, which we could find here, seasonality, see this tab, seasonality. So on average, Apple moves down 1.5% between this period. Well, if it did that, obviously the stock will be lower and below the strike. So again, you lose 100% of your investment. What about if we just looked at that, not the seasonality, but that just the average move in a 10-day period using historical data? So over here, that would be here. This is a 9-day hold period. We have 49 historical observations. And on average, the stock does move up 1.1%. Okay, so using that, on average, if we move up 1.1%, what will be the payoff of this option, right? Would it be in the money? And by how much? So based on what the option is worth minus what you paid for it, what is the payoff? So let's go over here. And still we're down, if average move here, still we're down 100%, okay? Basically, that 1% move is not enough, okay? It's not enough. We're still down 100%. If the stock is flat, if it's at 246.90, right? What do we lose? 100%. What if if the stock, right? So all these, and if the stock moves its average move, seasonal move, also down 100%. So basically, here we could see there's a lot of scenarios. If we use historical data, you're risking 100% of the investment. So what's the potential return? Let's say it goes our way, right? So we could separate. Let's separate the positive moves from the negative moves. So obviously, if the stock moves up, that's better for us, and that's what we're counting on, that the stock does move higher. If we're buying a call, well, we think that there's a better chance the stock is going to go higher than lower. So then we could, but we don't know by how much it's going to go. We don't know what it's going to go up by, right? We need to kind of estimate it. Well, if it does go up, right? If it does go up, what does it usually go up by? And if it goes down, what does it usually go down by? If we just separated the positive and negative moves, right? So if we looked at that and we looked at the historical distribution and we said, okay, when the stock does go up over here, on average, if we took the average of all the up moves, it's up 3.5%. And when the stock goes down, if the average of all the moves were down 2.6%. So if we said, okay, what if it does do that 3.5%? All right, if we're positive on this stock and we think it's going to perform, whatever on average it does when it goes up, 3.5%. What would be my payoff then in this call? Because maybe I have a minimum. Maybe if the payoff is 10%, it might not even be worth it, right? Because you're risking a lot here, so that might not even be worth it at this point. And maybe you're looking for at least a double or a triple. Like maybe you have some kind of minimum payoff requirement to take on that risk. And So that's the question. What would be the payoff, right? If we're gonna take on this risk. So that's what this is. So this is gonna go strategy payoff and says, well, if the stock moves up by that average up move, which we calculated 3.5%, right? So we go from 246.90 at 3.5%, right? So then we take that stock, subtract it from the strike price. That would be the value of the option at expiration, right? Whatever its intrinsic value is. And we take that value, subtract it from what we paid, and then divided it by what we paid. What would be the return? Is it positive? Is it negative? Is it break even? So here it says that the return is 181%. So more than double. Okay. 100% would be double, so more than double. So if we're very bullish and we think that, there's a good reason in your analysis of the stock to believe that, the next 9-day period move, there's a better chance that it moves up and achieves at least its average, up move than down. Well, then the payoff looks, like 180%, which is pretty good. We could also look at it from another perspective and say, what if it does its seasonal average move up, right? So let's say in a particular period, calendar period, if we took the up moves and down moves, they might look different, right? Maybe the up moves are not as to the same magnitude as they are in a typical 10-day period because we just happen to be in a low volatility environment. Maybe December, let's say, with all the holidays and stuff. So let's test that out. So here it's looking at the seasonality and says, well, between December 9th and December 20th in the last 12 years, we could see here there are more down moves than up moves for sure. But when it was up, what was the average move to the upside? 3.6%. So if we apply that, we could see that the payoff is 194%. So in those two scenarios, it looks like the payoff is pretty good, especially if you give it, if in your analysis or assumptions, if you think there's a 50-50, let's say there's a 50, you think there's a 50-50 chance that it does its average move up or not, then this looks like a good pick. So what about a one standard deviation move? So what if we just took a standard deviation move given its historical volatility, its most recent historical volatility, and the stock just does a one standard deviation move to the upside in that 9-day trading period? Well, this tells us that in that case, this option will lose 63% of its value. So not 100%, it'll be a little bit in the money, but it won't go up enough to cover the cost of that option. Even you're going to lose 63.7% of your initial amount at risk. So this way, we could even filter things out if we wanted to. Like we could say, here's the payoff at expiration. And let's say we had a minimum, like if the stock does achieve the average move to the upside, we want to be at least double, say 100%, right? It has to be above 100%. So you could see here that all these will be above 100%. We could also do that for the seasonality, right? If average seasonal up move, we want to at least double. above 100%. So you can see it keeps narrowing down. You have like 10,000 observations. So Apple's still up there. You have these two. What if we wanted the same thing on a 1 standard deviation move? Let's say a standard deviation move, if it's up one standard deviation, maybe we want to double there. Okay, so not as many. There we go. So maybe that was too ambitious. Let's do a 75%. Okay, 253. So this is a way, right, to look at, maybe we want to even set a minimum. We don't want to, let's see if this happens on the down. If 1 standard deviation moved down, maybe we want to how do I? Okay, this would, right, this would not. So let's leave it at that. And here, what we're doing is saying, okay, we want to not only screen by theoretical value and the technical indicators of the stock. And so what we did before, we want to have a screen for estimating the payoff and getting the minimum, payoff based on those historical stock return distributions. That's a starting point, right? Then you could go and research that call option further, but this is a way to quickly narrow down the potential candidates. So like you see here, just in December 20th, right, that we were looking at expiration, we narrowed it down so far to 253 candidates from, I think here, let me clear this, from originally over 11,000. All right, so I think, well, I'm going to stop there for today.
Awesome job, Dima. For everyone who didn't hear earlier, we do have a webinar with IBKR today. That link is at the top of the chat. So go to that. You have to register with IBKR. Awesome job as always, D. Thanks so much.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Oh, and hope to see you guys later today at 2 p.m.
Yeah, and if you can't catch it later today, as long as you register, they'll let you know. It drops into our library. We have a large library. I think there's either this is a 36th or 37th webinar we've done with Interactive Brokers. So it's all good stuff. So go to that library as well. And I'll put that in the chat. Thanks, Steve.
Yep. Thanks, Orion.
Bye-bye.